We're back with Martin Pelletier. He's Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel. We're going to talk about Martin's views on the U.S. stock market. We'll show a graph of the S&P 500 index. Martin, as you know, it has also soared recently. It's had a very good month of April from about the first week of April onward. It's now about 3% off record high territory. What is the S&P 500 telling us about investors' perceptions of the U.S. economy and where it goes from here?
Well, it's really interesting. You've got two different stories out there. You have the U.S. consumer. That sentiment came out saying, that it's at the lowest level since May of 2020. So the U.S. consumers are quite worried about tariffs. The bond market, bond market is also pushing back. You have U.S. 10-year yields at 4.5%, and 30-year, 20 and 30 years at 5%. And so they're saying, well, we're a little cautious about the impact of tariffs. At the same time, you have a lot of fear of missing out buying on U.S. tech. I call them levered beta because they have done fairly well, rocketing back off their lows and now pushing the S&P into positive territory this year. And so you have stock market that is being quite aggressive in regards to its outlook, bond market being and consumers being a lot more tempered. The big question: who's going to be right? Who's going to be wrong? And if I'm looking at where these big tech companies and what they're doing CapEx cuts. We're seeing layoffs, Microsoft and others, for example, to try and meet their earnings expectations. We had a really good Q1 out from a number of these companies. And the big question is how much of that is priced in. So I think we're going to see a very choppy equity market in the U.S. for the next couple of months, especially as we get more details around trade flow. The Chinese the news on the Chinese trade agreement or potential agreement and lowering the potential impact from that certainly was quite a positive development for equities in the U.S. But from the growth perspective, how much growth is there going to be when there still is that overhang and CapEx cuts and layoffs? I don't know, and so we're just. We're maintaining a position in that sector in the U.S. and but we're just being a little cautious.
Do I hear you saying that there may be a disconnect between the very robust performance of the U.S. stock market and all those S&P 500 companies that have either pulled their guidance or reduced it?
Yeah, and so, if you look at earnings revisions, there's been a lot of revisions. It was still a half decent quarter in regards to beats. But there's, if there is a potential for large drawdowns, if any company does not deliver on their expectations. And so you have to be very careful in that space because maybe we're past Q1 here, but as we get into Q2, anybody who stumbles or has any sort of weakness will get punished severely. And I still think that because that volatility has dampened and is not as high as it was a couple of weeks ago, doesn't mean it won't return. And so there's still some large tail risk potential if you're picking stocks in the U.S. if they don't deliver. And so I'm just saying, just be a little careful about that because growth expectations are quite high and they better deliver.
One of the other narratives that investors embraced after the election of Donald Trump in November was the theme of deregulation that would make mergers and acquisitions easier to propose and easier to get across the finish line. Is that where do we sit there now?
I think there's a lot of talk.
Yes.
And so people are going to want to see proof is in the pudding. I think the same thing in Canada. We had Carney come in and say we're going to build these pipelines and we're going to deregulate, but we're still going to keep Bill C-69. And so until we start to see some actual changes in those regulations, both in the U.S. and in Canada, we're not going to see that consolidation activity take place to the same extent as what many people expect. Same thing about tax cuts and other things. So it's all talk until we actually start to see proof of it. And so I think investors and companies are going to want to sit back a little bit and not be proactive or get ahead of things until they start to see some of that take place. And you can see that in capital market, you can see that in CapEx programs that are being cut across the board, data centers and that sort of thing. And if they're doing that on operations, why would they do it on consolidation, especially with the rally back in valuations.
Martin, thanks a lot for two really good conversations. Martin Pelletier is Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel. Just ahead,